What does the Federal Reserve really know, when it comes down to monetary policy and the economic outcome in a low-growth, low-rate environment?
Really not much, except that I think there's an accumulation of evidence that monetary policy is pretty ineffective. For a while, we came into this thinking monetary policy at zero rates was ineffective. Then along came QE. Then along came negative rates, which I have to admit that I didn't think that was possible. It turns out, so we said, oh, there's all these other things that central banks can do, but it's not actually doing very much. So you have negative rates in Europe, and they still can't move inflation up. You have massive QE. How much good did that do? I think so. It looks as if the things that we may in some ways be going back to square one, which was when we started this discussion. When I started this discussion 18 years ago, it was that the only thing you could do was to credibly promise higher inflation in the longer run. That was credibly promised to be irresponsible was my phrase, and that only by really creating the impression of a regime change that was going to change what you do, even after recovery, that was the only way that monetary policy was going to get traction. And we're kind of most of the way back to that view, I'd say, right now.
So is John Williams, the president of the San Francisco Fed, correct in saying perhaps we should set higher inflation targets, maybe even target nominal GDP?
Well, I would say the inflation target is easier to explain, and I've been for that for a while. I mean, I've been, I went to the ECB research conference, said that. They were all very polite and nodded and then ignored me. But no, I mean, that's really where we came. That's where I came in 1998, talking about Japan. It's the same thing.
So yesterday we got this note from John Williams, head of the San Francisco Fed, and he laid out some possibilities for what, his rethinking. And he said maybe commit to higher inflation, or maybe we need more aggressive fiscal stabilizers, or some sort of NGDP target. And when I read it, my thought was, this is stuff that I feel like people have been talking about for years. I guess the real story is that it's coming from someone so central at the Fed.
That's right.
Why has it taken so long?
I think a lot of it is history. I mean, central banks, there was blood, sweat, tears, and toil to get inflation down from 10% to 2%. And they all settled on this 2% target, and very, very hard to say, maybe that was set too low. Maybe we really need to change this. That's been something they've been really, really reluctant to rethink. And even now, I mean, it's news that anybody at the Fed is willing to even entertain the notion. But yeah, these are not new ideas. It's just who's saying it, not what he's saying.
So when we talk about central bankers and the formation of ideas, we've got a big meeting next week at Jackson Hole. When you're watching these types of consortiums or meetings of minds about economics and central bank policy, what do you want to see? What do you want to hear next week?
Oh, gosh. I mean, I'm much more interested in reading the research papers. I mean, the central bankers, if a radical rethink is going to happen, it's not going to happen in open discussion on the floor at in the Grand Tetons. It's going to happen behind closed doors. So those are fun. I mean, actually, I think I've been blackballed from Jackson Hole since I criticized Alan Greenspan many years ago. But it's those are good means. So I think the value there is to have the central bankers exposed to some smart academics talking about stuff.